Did you know that the Jersey Shore's hospitality market is booming, driven by strategic investments and growing demand for both leisure and business accommodations? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In recent news from travel and tour world, Peachtree Group, a prominent leader in U.S. commercial real estate, has launched a new 114-room residence inn in Ocean Township. This strategic development taps into the growing hospitality market along the Jersey Shore, capitalizing on the area's expanding demand for modern accommodations. The new Residence Inn offers prime access to nearby beach destinations, making it a significant addition to the region's thriving tourism sector. The Residence Inn Ocean Township is situated in Monmouth County, one of the wealthiest areas in the United States, known for its robust economy and high median household incomes. This location is well positioned to attract a steady stream of both leisure and business travelers, particularly during peak seasons. Its proximity to popular Jersey Shore destinations like Asbury Park, Long Branch, and Sandy Hook ensures a consistent influx of guests. Significant economic growth in the region is anticipated, with Netflix investing $900 million to transform the nearby Fort Monmouth into a major East Coast production hub. This redevelopment is expected to create approximately 3,500 construction jobs and 1,500 permanent positions, boosting local demand for hospitality services. The Residence Inn Ocean Township is poised to be a lucrative investment in this prosperous market. Peachtree Group's investment strategy includes structured investments through Delaware statutory trusts, providing an attractive avenue for investors. This approach allows them to leverage 1031 exchanges, reinvesting proceeds from the sale of appreciated real estate into new properties without immediate tax obligations. Peachtree focuses on acquiring well-established hotel brands in high-growth markets, aiming for value-add opportunities and strategic partnerships with experienced hotel management teams. To date, Peachtree has launched 8 DST properties with a combined portfolio valued at over $220 million. Each transaction is debt-free, providing investors the chance to invest in prime real estate with minimal financial risk. This aligns with Peachtree's vision of acquiring and managing premium hotel assets in sought-after locations, offering a reliable income stream through passive real estate investments. For 1031 exchange investors, Peachtree's DST properties present an efficient, tax-advantaged path to reinvest capital gains. By transitioning from active ownership to passive real estate investments, investors can diversify their portfolios and enhance returns without the burdens of direct property management. Peachtree's approach ensures continued exposure to the hotel sector, known for delivering stable income and long-term appreciation. The new Residence Inn in Ocean Township exemplifies Peachtree's commitment to prime locations and high-demand markets. The company's consistent track record of acquiring assets that meet current investor needs reflects its strong market knowledge and expertise in commercial real estate. With a robust, tax-efficient investment structure, the Residence Inn Ocean Township DST represents a promising opportunity for investors aiming to diversify their portfolios and tap into the hotel sector's growth potential. In a recent article by Audrey Henvey, Presidium's co-founder and co-chief executive officer, John Griggs, offers insight on why the Dallas-Fort Worth multifamily market is currently at an inflection point. According to Griggs, the market is resetting with capital markets remaining tight and new construction slowing down. Despite these challenges, the fundamentals in Dallas-Fort Worth remain strong, presenting opportunities for patient capital to re-enter the market. Griggs highlights that Dallas-Fort Worth gained nearly 500,000 people between 2020 and 2023, marking it as the fastest-growing metro in the United States. This population growth has been accompanied by an 11% rise in employment since 2020, further fueling demand for rental housing. The cost of homeownership has significantly increased, with mortgage and insurance rates climbing. As a result, renting has become a more attractive option, particularly in well-located areas, sustaining demand for quality rental properties. On the supply side, Griggs notes that construction financing is available, with regional banks resuming lending after a prolonged hiatus. However, higher rates and increased equity requirements pose challenges, leading to a predicted slowdown in new deliveries. This deceleration is expected to tighten the market, creating opportunities for investors to acquire high-quality assets at prices below their 2021 peaks and replacement costs. Griggs explains that Presidium's strategy has shifted over the years. Initially, they acquired over 20,000 multifamily units between 2005 and 2017. In 2018, in response to rising asset valuations, they pivoted to new developments, delivering over 7,000 units while selling off much of their legacy portfolio. The pandemic and interest rate spikes were unforeseen, but this strategy insulated them from the overheated buying environment. Now, with values resetting, Presidium is back on the offensive, seeking assets with downside protection and strong submarket dynamics. They plan to continue building selectively as supply tightens and rents stabilize. Griggs emphasizes that the broader Dallas-Fort Worth commercial real estate market is transitioning, with lending momentum increasing and significant employers like Goldman Sachs establishing roots in the area. This signals the region's enduring real estate investment appeal. BKM Capital Partners and Kayne Anderson Real Estate have announced a significant move in the industrial real estate sector with their new $1.5 billion joint venture. This collaboration is set to target high-growth light industrial properties focusing on small bay and mid-bay industrial spaces. The initiative aims to capitalize on the ongoing demand within this niche market. The joint venture's strategy is centered on acquiring middle-market properties that currently have below-market rents, high vacancy rates, and operational inefficiencies. By purchasing these assets at discounts to their replacement costs and far below peak pricing, the venture plans to reposition them, thereby enhancing their value. This approach not only aims to maximize returns, but also to address underutilized spaces in the industrial sector. Brian Malliette, the founder, chief executive officer, and chief investment officer of BKM Capital Partners, describes this joint venture as a transformative step for the company. With over a decade of experience in the industry, BKM is poised to leverage its expertise to optimize the performance of these industrial assets. Private wealth has been making significant strides in the commercial real estate sector, with a particular focus on the Americas. A report from Jones Lang LaSalle, a prominent real estate group, highlights that from 2013 to 2024, private wealth has contributed an impressive $1.5 trillion in private deals globally. The Americas have been at the forefront, attracting the largest portion of these investments, underscoring the region's appeal to high-net-worth individuals and family offices. According to the report, the United States stands out as the most popular destination for private wealth investment in commercial real estate, capturing 40% of all investment volumes between 2013 and 2024. This trend reflects the growing influence of private wealth in the real estate market, complementing traditional institutional investors. In the broader Americas region, $643 billion was invested, outpacing Europe, the Middle East, and Africa, which saw $566 billion, and the Asia-Pacific region, which attracted $318 billion. Offices were the top investment choice, drawing $464 billion in capital, followed by living assets, retail, industrial and logistics, and hotels. Richard Bloxham, CEO of Capital Markets at JLL, notes that private wealth investors are becoming one of the most active and influential participants in the real estate market. Their participation is expected to increase, with investments not only in direct property and operators, but also in private real estate funds and other positions within the capital stack. The data showcases a dynamic shift in the investor landscape, with private wealth playing a crucial role in shaping the future of commercial real estate. This trend highlights opportunities for potential investors to explore the burgeoning market of private wealth-driven real estate investments, particularly in high-demand markets like the United States. Thompson Thrift, a full-service real estate company, recently held a groundbreaking ceremony for the Gilmore, a 35-acre mixed-use development located in the Phoenix suburb of Gilbert. This ambitious $225 million project is designed to cater to the evolving needs of the community by blending residential, retail, and public spaces. Ashley Boyd, managing partner of Thompson Thrift Commercial, expressed excitement about this milestone, emphasizing that the Gilmore is set to become a vibrant destination in the region. The event was attended by notable figures, including Gilbert Mayor Scott Anderson, who highlighted the development's alignment with the community's spirit of connection and innovation. Strategically located at the northwest corner of Val Vista Drive and German Road, near Loop 202, the Gilmore will feature approximately 200,000 square feet of grocery, restaurant, and retail space, alongside 300 luxury apartment homes and a hotel. The project has already secured more than 25 leases, including a 64,000 square foot Safeway and various dining and retail establishments. The residences at the Gilmore will offer 300 studio, 1, 2, and 3-bedroom apartments, each averaging 1,000 square feet of living space. The development is designed to foster a sense of community, featuring Main Street-style entrances, covered walkways, common areas, and outdoor gathering spaces adorned with local art and lush landscaping. Andrew Call, Thompson Thrift's Vice President of Development for the Southwest region, emphasized that the Gilmore is about fostering connections among people and places. The development is poised to become a hub for business, leisure, and community life, with retailers expected to open in late 2026 and residents moving in by early 2027. Thompson Thrift is actively engaged in several other projects across Arizona, including the Elliott Tech Center in Mesa and the German Commerce Center in Queen Creek. The company remains committed to investing in high-growth markets, focusing on delivering quality mixed-use retail and industrial spaces. Thompson Thrift has a long-standing reputation as a trusted partner in real estate, with nearly 40 years of experience and over $6 billion invested in local communities. The company's dedication to quality development is evident in its recognition as a 2025 Top Workplaces USA Award winner. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.